Hello, I'm Charles Tarbey, filling in for Chris Gray, and on tonight's show, what is the latest property index for valuing property growth around Australia? Why is it different to how we valued property before? That's a really important question because there's an extensive program that CoreLogic have put in place. Now, how property values have increased in the last real estate cycle around the country, it's going to be good to see that. And is there much of a difference in the performance of expensive properties versus cheaper ones? Now, joining me tonight is Tim Lawless, Director and Research of CoreLogic. Now, Tim, before I go into the questions, I want to ask you, your football, is it AFL, is it NRL? What is it for you this weekend coming up?
Well, it's actually neither of them, to be honest with you. If anything, I'd be watching the rugby, but that's what my son plays. But I'm not much of an armchair sportsman, to be honest with you, Charles.
Okay, well, I'm back in the Caulfield Colts in Victoria, the soccer team, for Henry Lowenstein this weekend. That's about as much as I know about the sport as well. Golf is pretty much what it's like for me. So, Tim, earlier this month, CoreLogic successfully rolled out its next generation hedonic home value index. Now, what is that? What is that index, and why is this preferred, or your preferred measurement of the housing market?
Well, a lot of people ask the same question. In fact, a lot of people ask, what's our hedonistic index? I can assure you it's actually a hedonic index, and all hedonic means is it's an attribute-based valuation measure. So rather than measuring pricing observations like a median price, what the hedonic valuation measurement does is we measure the value of every single property across the entire housing portfolio. So when we're talking about Sydney housing prices have risen by, say, 5% or 10% the last year, what we're talking about is the entirety of the Sydney housing market, not just those properties that have transacted.
Well, why is this methodology, from your experience, so it's very extensive experience, a lot of people don't know Tim's got a real estate background all the way back up on the Gold Coast with the original, I think, PRD back then, and right now through CoreLogic, he's one of the most informed people, if not the most informed person when it comes to this information. So why isn't this methodology used by everybody?
Well, the simple answer is it's really data intensive. So if you look at the methodologies that have been legislated for use across Europe, for example, they're hedonic indices. So if you look at CPI measurements across Europe or housing market measurements, they're using hedonic regression methods. What we find in Australia is that actually getting data on the attributes of a property, number of bedrooms, number of bathrooms, a land area, when the property was built, is really difficult. So we spend about $20 million a year just acquiring that really rich, comprehensive set of data.
20 million a year, I can't even say the word, so spell it for me again.
Hedonic.
All right. So what are the latest, no, I wasn't very good. I never got many holy cards at primary school for spelling. What are the latest numbers showing, Tim?
Well, it's a pretty diverse market out there. We're actually seeing the market is just slowing down a little bit in Sydney now. Of course, we're more than 5 years into the growth cycle, about 5.5 years since this cycle kicked off in 2012. We've seen Sydney dwelling values rise substantially over that growth phase. Melbourne very similarly as well. But the last 12 months, we've actually seen Hobart come in as the #1 performer. 13.6% rise in values across Hobart. Sydney's up about 13%. Melbourne just a little bit less than that. What we're seeing here is a real changing of the guards. Sydney's really slowing down. The last quarter, we've only seen Sydney dwelling values rise by about 0.5%. Melbourne's up by about 2%, but Hobart and Canberra seem to be gathering some momentum.
Yeah, Melbourne has been my pick for some time. Melbourne, Canberra and the Sunshine Coast have been my 3 picks all year. And so it'd be interesting to get your views on those areas, those other areas as well.
Well, Melbourne seems to be quite a resilient market. We're still seeing values rising, just not as fast as what they were rising, say, in November last year, when it looks like the rate of growth peaked, but still a very strong market. You can see that at auction clearance rates. But as you said, look at markets like, say, a Hobart, where the sheer affordability of housing, and now we're seeing improving economic conditions, very strong marketplace there. The Gold Coast, the Sunshine Coast, in fact, all the lifestyle markets along the eastern seaboard, Byron Bay, the central coast of New South Wales, all showing very strong conditions now as we see tourism really improve.
Yeah, before we look at the next chart, you know, those areas are quite interesting because, as you know, and we always talk about the 1,000 different marketplaces we have across Australia, and we always generally hear about the auction clearance rates in Melbourne and Sydney, and a lot of people have gauged the entire marketplace on that. I was chatting to the guys in Perth recently. They're sort of maybe not even still at the bottom, but they're very, very close, which makes that marketplace a pretty strong marketplace to look at. And some of the guys have been telling me that the property in that marketplace is actually selling today lower than pre-boom, which I found very interesting.
It makes a lot of sense to me. If you look at where the Perth market's been, since it peaked back in 2014, values are down around about 10 to 12%. Not quite as severe as Darwin, where we've seen nearly a 20% correction across the Darwin market.
Okay, let's look at another graphic. Tim, you can explain this one for us too, change in dwelling values as well.
Yeah, so if we're looking at the marketplace since 2009, this is a post-GFC phenomenon here. Of course, we've seen Sydney and Melbourne really dominating the growth stakes. But if you start to look at markets like, say, Adelaide or Brisbane, you can clearly see that the rate of capital gains has been nowhere near as high. In fact, over the past 5 years, we've seen Brisbane dwelling values and Adelaide values have risen only by about 20%, so around about 5% on average each year. Relatively sustainable growth, you could probably describe it as, but certainly not slowing down just yet in either of those markets.
Yeah, we've been hearing a lot about the southeast Queensland market. That's an area that constantly comes up all the time. In fact, there's an ad on one of the radio stations that suggests I recommend it, even though I can't remember saying it. If you were going to buy a property right now, what marketplace would you look at? I know this is a sort of off-the-cuff comment, but I know you could answer it.
You probably know my answer as well. I'm a big fan of southeast Queensland. If you look at southeast Queensland on paper, the fundamentals look really strong to me. You're looking at a market that's very affordable, hasn't really seen a great deal of growth just yet, so it's quite early in its growth cycle. The yield profile is really healthy. We're seeing gross yields generally up around about the 4.5 to high 4s mark. And also, we're not seeing the affordability challenges that we're seeing in markets like Sydney or Melbourne. The dwelling price to income ratio in Brisbane, for example, is just a little bit below 6 times, which, you know, from an international perspective, sure, that's still quite unaffordable. But compared to, say, Sydney, where it's about 8.5 times, Melbourne, nearly 8 times, Brisbane's a much more affordable market.
It's interesting because it's taking off in parts, but it still hasn't taken off significantly in Brisbane. I don't quite know what it is, whether people are worried about the economic situation there or jobs, but there's a mixed story now coming out of Brisbane, particularly with the apartments are off the plan sales. So I think housing is safe. Apartments may have a little bit of a challenge.
Particularly inner city apartments, and I think a lot of people highlight that Melbourne and Brisbane, to a lesser extent Perth, have a real issue around oversupply. I'd argue that Brisbane really stands out to me as being probably a bit worse than what the Melbourne market is. If you look at how many units are due to settle in Brisbane's inner city over the next 2 years, it's about a 20% uplift in the existing stock levels over a 2-year period.
Okay, let's have another look at another graph. You've come very prepared this evening, that's for sure.
I love my graphs.
So it's a change in dwellings values since 2009.
In Perth and Darwin, I think is the next graph we're showing, really highlights the downturn these two markets have seen. If you recall prior to 2009, Perth and Darwin were markets that were absolutely outstanding. In fact, over 2006, we saw Perth dwelling values rose by about 45% in the space of 1 year. So we've really seen the mining downturn affect these markets. So since 2009, we've seen Perth dwelling values, they've increased by about 5%.
It's a frightening chart when you look at it, isn't it, when you see that change through there. But let's look at the Canberra and Hobart. These are Canberra's particularly, and Hobart, they've had some really successful runs, haven't they? Yeah,
so these are two markets that are gathering momentum. We've seen the economies pick up in these markets, particularly around Tasmania and Hobart, driven by improvements in tourism, rising employment levels as well. Of course, in Canberra, there's a lot more confidence now. Back in 2010, for example, when the market was going through a downturn, there was a lot of concern around job shedding and so forth. Absolutely not the case anymore. A lot of that apartment supply that was problematic for some time in Canberra has been absorbed now. We are seeing the marketplace tracking quite healthily for both houses and apartments.
Yeah, great to see. Hobart's always pretty much the last one to take off once the rest of the country's moved and the equity's being gained. The final chart, Tim, before we look at some of the charts that I've got, the stats I've got this week, and this is the change in dwelling values 12 months to August 2017.
So this really highlights the diversity just over the past 12 months across Australia. When people say Australia's had a housing boom, You can see from a map like this, it's not really the case. It's pretty much the southeast corner of the country that's seen fairly strong price rises. Of course, the most of middle of Australia is uninhabited, very sparsely populated, but even look at markets like Perth or Darwin, along the eastern seaboard through Queensland, no growth at all. In fact, a lot of blue there, which suggests negative growth.
Okay, well, let's talk about what's happening around the property market around Australia. It's a wrap I like to do each week. We've had our clearance rates. So the one we look at closely, and for the first time in a long time, Sydney has come in the auction clearance rates at 69.6%, Tim. So it's under the 70, and it hasn't happened like that for a very, very long time. The overall clearance rates across the country were 70.3%, only slightly up on last week at 70.2%. But here that trend is still continuing when you look at the Canberra and Melbourne markets. So Canberra actually came in at 73.1%, while Melbourne came in at 73.6%. So really still extraordinary clearance rates. Although Adelaide itself didn't have a lot of auctions, it came in at 75%. So it actually topped the tree when it came to the overall clearance rates. But look, from my perspective, as an auctioneer as well, those clearance rates are very, very good when you look at those capital cities. You know, when you look at some of the other capital cities that have struggled, it gets very, very scary. The one that Chris always likes to refer to, the next chart, is properties coming on the market. Now, we've had a few weeks of increase. It hasn't been as significant as I expected it to be. So the chart's only showing a very slight increase of 0.15%. So nothing fantastic, although we know that there are a number of auctions being booked right across the country. The stock levels should be a lot higher from what I would normally expect this time of the year. And in some parts of the country they are. But where we need it most, it's still lagging behind. So I really don't know where we're going to go with that. We have had the climbs, but we haven't had the climbs that we needed. So again, people in certain areas of the marketplaces around the country are still going to struggle because those different levels of stock, well, they're just not there. There was an apartment complex that sold out over a weekend, 250 million of sales in a weekend, 80% of that in the middle of the city of Sydney, and there are only 2% of those buyers that were from overseas. So there's a lot happening here now. Our next chart, rental movement. There's one that really stood out here, and that's Hobart, 2.39% climb in 1 week, which is really quite significant when across the country we had a negative 0.23%. Not a lot of movement in the other capital cities, but that particular one, well, that's the one that stood out to me anyway, and I was really quite impressed with that marketplace. And finally, when we look at the vacancy rates, now this is an area that I've been focusing on for some time, particularly in the Perth market. So overall, Melbourne has been performing better than any other market when it comes to vacancy rates. It's something that we normally see out of Sydney, but the vacancy rate in Melbourne last week was 1.02%. So that is stunning. It was under 1% for a little while. We've seen that happen. The other marketplace that was also very powerful was Sydney, 1.93%, so still a lot higher than Melbourne, but Perth, and Perth is the one, again, I keep watching all the way through. It was actually 7.51% vacancy rate last week. This week it's climbed up to 8.03%. It has been over the 10s, and so that's an area that's always bothered me, but I'm watching that marketplace very, very carefully, because I think at the end of the day, if that marketplace starts to change, I think the rest of the country is going to change. So we're going to take a short break, and we'll be back, and we're going to catch up with Tom Panos, and we're going to keep in touch with what Tim's got in store for us, some more charts to look at. So see you after the break. Welcome back to Your Property Empire. Joining me tonight on the show is Tim Lawless, Director of Research at CoreLogic, and we've been looking at a series of stats, and I did get the hedonic, I tried to correct that with Tim. I thought I might have said it incorrectly, but he's having a go at me as per usual. So using the CoreLogic Stratified Index, and I got that word right too, CoreLogic figures are showing the residential market, luxury residential market, real estate markets in Sydney is better earner than mid-range and low-end property. However, the reverse is the case in Melbourne. How interesting is this? We're going to look at a graphic on these two, but Tim, tell us a little bit about that.
So this is really interesting, and when we quote property market performance figures, it's generally at a fairly macro level, and the important thing is for anybody looking at the market, when you drill down and you start looking at the performance across different product types or across different pricing categories, you can see there are very different performances. So look at Sydney, for example, we're seeing the top end of the market, we're seeing values rising at about 14%. Look at the bottom of the market, values rising about 13%. Subtle difference, but if you add that up over some time, you'll find that generally the top end of the market in Sydney has performed quite strongly, more strongly than the lower end of the market. Whereas, as you say, in Melbourne, it looks like it's the more affordable end of the marketplace that is showing a better rate of capital gain. We're seeing in Melbourne the most affordable quarter of the market up 15% compared to a 12.5% capital gain at the top end. I think part of the reason for this probably comes back to the fact that housing is much more affordable in Melbourne compared to Sydney. But another factor is comes back to what's the makeup of demand in the market. If you look at Sydney, most of the population growth in Sydney is coming from overseas. In fact, there's a negative rate of interstate migration. Look at Melbourne, and most of the population growth is coming from interstate, where I think a lot of that demand is looking for the more affordable end of the property market.
Yeah, I'm finding it fascinating looking at the chart because, again, you look at the Perth marketplace or you look at the Darwin marketplace and they're certainly, you know, well below the rest. But the other interesting one is Brisbane. So Brisbane, for some reason, it still seems to be performing behind other capital cities such as Adelaide, whereas you might expect Brisbane to have performed better over the last few years. Just from your experience, what do you think that's all about?
There's a couple of things going on in Brisbane. One of them, of course, the missing ingredient, which is now starting to improve, has been jobs. We haven't seen much jobs growth across the Brisbane market. And of course, in Australia, you generally need a job before you'll get a mortgage. So that helps. So to see jobs growth now improving across southeast Queensland, I think is a key driver. The other factor behind some of these figures is that when we look at the headline figures for Brisbane, there is this drag down effect from the apartment market, which is down about 3% over the past 12 months, whereas detached housing's up about 5% over the past 12 months. So when we look at the combined dwelling market, that does tend to even things out a little bit.
Yeah, it's a very interesting marketplace to watch, all the marketplaces to watch and match them. And this is what I find so hard, Tim. You've got so many different marketplaces, as I mentioned earlier on. How do you keep control of watching and predicting? And I know with CoreLogic, when we talk about the way in which you value your properties, I use your automated valuations now on a regular basis, and it gives me a very, very strong guide. How do you now consolidate all of that data across the country and start to look at where you think, because a lot of people talk about hotspots when they're already hotspots. So how do you look at a marketplace? This is, again, just a question without notice. How do you look at these marketplaces yourself personally and start to think to yourself, this will become a hotspot rather than it is a hotspot?
Well, I think there's a few ways. One of them is, as you say, looking at those markets that have already shown a very strong upwards trend in growth. And quite often what you find is it's the next best suburbs that tend to take off. So that's the ripple effect that a lot of investors look for in a marketplace, is growth ripples outwards from the highly desirable suburbs to the next most affordable but still very strategically located suburbs. Another way to look for hotspots, of course, is to follow the investment. So look for big infrastructure projects. Generally, when you find there's a lot of money being spent in an area, capital gains will typically follow, because you'll find, say, with road construction, that improves transport time and creates jobs. If there's additional transport or public transport options being rolled out in the suburb, once again, that improves the desirability and the accessibility of the suburb. Probably two key ways. We're
going to cross to Tom, but I got to tell you, I did speak to some boys in Caloundra today, up in Maroochydore and Caloundra, Matt and Grant and Damien, and there's a significant amount of money being invested there when you talk about infrastructure, 400 million on the airport, which is going to have international look and feel. Tom Panos, let's talk about the three properties. Good to speak to you again. I spoke to Tom earlier on. Let's look at those three properties we have tonight. Tom?
Hey Charles, how you going?
Good, thank you.
Okay, let's start with I've actually only got one property on.
Tom.
Yep.
And I'm trusting that it's a Century 21 property, of course.
Charles, I got good news for you.
Okay.
It is. It's from your Century 21 office in Central in South Australia, and in particular, Adam Teague. And regardless of it being Century 21, Charles, this one did catch my eye, because at the price range that they're talking about, $815,000 to $855,000, $100,000. So we're talking extremely affordable when you look at the scheme of things across Australia and median values. It's only 2 kilometres from the CBD. It's also very close to cafes, restaurants, cinemas and boutique shops. You know, it's a Torrance-style home that was built about, I'd say, 10 years ago. And I've got to tell you, well-appointed kitchen and what have you throughout the property, as it's up there on the screen. It's got everything that you'd want. And we're talking under $1 million, Charles. So go and see the Century 21 office in South Australia, known as Century 21 Central.
Yeah, that particular office is run by a very dynamic young man, Adam Teague, and his team. And it's interesting to see the prices in SA, Tom. There's some incredibly high quality properties in Adelaide. I've always admired a lot of the old stone cottages that are built. I mean, that city was designed for the aristocrats to move to from the UK. I think you can even see, I might be joking here, but you can see, if you're flying over, you can see some streets that are shaped in the flag, the Union Jack flag. That's how strong it is. Tim's laughing at me right now. So, Tom, let me ask you a couple of questions. I'd like somebody to try and prove me wrong on that comment anyway. Should you always use an agent that is local, or with all marketing now, or is it irrelevant where the agent is located to where and when you are selling?
Charles, look, you're one of the real pros in real estate, and you know that you've seen disruptors come along that'll tell you that if you market the property, put it online, it doesn't matter where the agent is, they can actually sell it from their living room. I actually think that that's absolute rubbish. I think that good real estate agents know their product inside out, that they actually sell the product not too far away from where their office is located. That way, they know everything about the market. They know where the schools are in terms of catchment zones. They know what properties have sold recently, and they know the kind of property that it was. So they can sit there in front of a buyer when they're negotiating and say, hang on a second, I think you should be paying $900,000 for this because, you know, Smith Street sold for $837 and, you know, Forbes Street sold for $853. And you only get that if you live and breathe your area. So I think always pick an agent that specialises in a specific suburb or region.
You've yourself, you specialise very strongly in the inner west of Sydney, and you're called upon by all agents to do most of the auctions there because of your experience. So I guess that justifies what you're saying.
Well, Charles, I've got to tell you, I actually feel uncomfortable when I've got to go to areas too further out because I want to be able to sit from a position of strength. I want to be able to be talking about the product so well. Like, let's face it, you don't go buy a mobile, an Apple iPhone off a Samsung specialist, right? So it's basically the new breed of real estate agent is a full trusted advisor. That's why I believe that you should actually stick to an agent that knows their farm area.
Yeah, I agree with you. Now, Tom, you talked about quickly a property in Newtown that you said that you sold on the weekend for under $1 million. Tell us a little bit about it quickly.
Well, you know, Charles, it was a one-bedder. It was on 90 square metres of land. It needed a lot of work. I'll be honest with you. At the time, I thought it was a really, I thought it was a reasonable buy. But after I saw that one in Adelaide and what you get for the same amount of money, I think to myself, maybe not so. But Charles, it's a sign of the times because under $1 million. Having said that, there's no way I'd call that a bargain because on 90 square metres of land, it really is not going to.
Interesting.
Yeah, but
Tom, and just before we go, you mentioned that auctions. Although I'm not seeing the numbers coming through yet, listings. You mentioned that there's a massive weekend coming up for auctions.
Yeah, well, I haven't got the numbers for this weekend, but we're going to know, obviously, in a week's time. I'm predicting it's going to be the biggest auction weekend we've seen in a long time. There are, the reason why, Charles, of course, is, the 1st of October long weekend. You've got, sporting grand finals, what have you, going on. It's going to be massive, and that's going to impact the clearance rate in Sydney. I know that for a fact.
Yeah, we're going to have a little bit on that one. We'll have a little bit after the show, Tom. Look, thank you very, very much for joining us, Tom Panos, and also thank you very much for Tim Lawless, CoreLogic, for joining us this evening. I'd like to thank all of you for watching, and also until next week, you'll see Chris Gray back on the show. So thank you again. Enjoy your evening.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.